All right, so concept check 4.3. First one is distinguish between two types of tax sheltered investment returns. Uh, so first would be employer sponsored defined contribution retirement plans. Those would be your 401k, 403b, and 457 plan. The other would be a traditional IRA. That income would be tax deferred, and the any investment gains you wouldn't pay those until you withdrew them. The tax treatments are different for IRAs and employer-sponsored retirement plans. So the so how do we reduce income taxes via our employer? Three employer-sponsored plans that do so. Premium only plan, again, that's health insurance. Flexible spending account allows us to deduct or pay for medical and child care expenses on a pre-tax basis. I did that this year with my wife had some surgery, and we knew she was going to have that surgery, so we put the money aside in a flexible spending account and used it. Nice thing about that is it's effectively paid for the procedure, and it's coming out of coming out of my paycheck every month. So my paycheck is lower, but that the cost of the procedure didn't come out of my pocket. So transportation reimbursement plans. So various transportation expenses for work are deductible. I'm not the limit used to be in the neighborhood of 200 a month. I'm not sure if that number has changed or not. So those again, all those are offered through your employer. Differences between an IRA, a traditional IRA, and a Roth IRA. Traditional IRA contributions are tax deductible. Earnings are tax deferred, and taxes are not paid until the money is withdrawn. The Roth IRA contributions are made with after-tax money, and earnings are tax exempt. So big difference in the way these are treated. The one thing with regard to withdrawals before you're 59 and a half would be subject to a 10% penalty. There are some exceptions, education being one of them. I believe financial distress, I'm not sure. First time home buyer as well. But they would pay a 10% penalty plus they'd be taxed at your ordinary income tax rate. Worst financial blunders that you can make managing income taxes. Turn income tax planning over to someone else. Over or withhold your income taxes to receive a big refund. You're making a loan to the IRS, which we shouldn't want to do. Ignoring income taxes and the impact of those on your personal financial planning. So moving forward, do it now. What protects your taxable income and tax total withholding for the year. Make sure that your withholding is accurate, and if you're over withholding, then you can file a new W-4 that will amend your withholding with your employer to correct that, either increase or decrease, whatever you necessarily need to do. Estimate your federal tax liability based on your income projections. Use the tax rate schedules. As I mentioned, revise your W-4 if necessary to withhold more or less, depending on your situation. All right, so that's the end of chapter 4.